This strategy comes directly from Keller and Butler's 2015 paper on Elastic Asset Allocation, or EAA. You'll learn the exact monthly trading rule, why it's called Generalized momentum, and the key performance metrics the authors report, especially for their two golden versions designed to be simple and robust. Most people hear momentum and think one thing: recent winners keep winning. EAA expands that idea. The paper argues that over tactical horizons, up to about a year, not just returns, but also volatility and correlations tend to persist. So the strategy prefers assets that recently performed well and are less tied to the crowd. EAA tries to build a portfolio that tilts toward assets with good recent performance while also emphasizing diversification by favoring assets that are less correlated with the overall universe. In the paper, the index isn't the S&P 500, it's the equal-weighted portfolio of all assets in the universe. Here's where it becomes actionable. The authors boil their approach down to two easy scoring rules. Defensive golden EAA, score an asset using the square root of return times 1 minus correlation. Offensive golden EAA, score it more aggressively using 1 minus correlation times return squared. In both versions, there's a hard filter. If an asset's momentum return is not positive, it gets a score of 0, meaning it's excluded. Here's the full trading rule in human terms. Pick a universe of assets. The paper tests different universes, small, medium, and large multi-asset sets. Compute momentum return RI, the author's average excess returns over T-bill yield across 1, 3, 6, and 12 months. Compute correlation CI, each asset's 12-month correlation to the equal-weighted universe index. Score each asset with one of the golden formulas. If RRI isn't positive, the asset is out. Concentrate on the best ideas. Keep only the top slice of assets by score. The paper uses a rule that scales with universe size, roughly like holding about the square root of n with a cap. Allocate by score. Higher score gets higher weight. Crash protection. This is important. If many assets have non-positive momentum, the strategy shifts that fraction into a defensive holding. What the authors found best in their test was US 10-year government bonds as the safe asset proxy. This creates a portfolio that automatically de-risks when the universe looks weak. The correlation term is clever because it's intuitive. When an asset moves like the rest of the universe, it's less helpful for diversification, so EAA reduces its score. When an asset is less correlated, it earns a boost. This is one reason EAA can act like a simplified proxy for more complex diversification or smart beta portfolio constructions. The authors don't just chase returns, they emphasize drawdowns. A big centerpiece of the paper is the Calmar ratio, specifically CR5, which is return above a 5% target divided by maximum drawdown. They also report volatility and Sharpe ratios, but their optimization focus leans toward controlling deep losses over long horizons. Now, the results people care about: what happened out of sample. In the paper, the model parameters are selected using the first 50 years, then tested on the next 50 years, 1964 through 2014. For the large multi-asset universe they label N equals 38, the golden models show strong reported outcomes. The defensive version posts about 12.8% CAGR, with about 7.9% volatility and a remarkably low 8.6% maximum drawdown over that long out-of-sample window. The offensive version pushes return higher, about 14.3% CAGR, with higher drawdown, about 14.1%, which is the trade-off you'd expect. The authors also report that in a majority of rolling 3-year windows, both golden versions beat the equal weight universe benchmark. A few implementation notes. This strategy rebalances monthly, so transaction costs and slippage matter. The paper assumes modest costs, and the results are based on index total returns. Also, the authors explicitly caution that early century index data might not have been available in real time, and real-world frictions, especially historically, could be higher. Finally, remember what this is: a momentum-driven, risk-managed allocation system. It can still underperform during abrupt reversals or unusual correlation spikes. That's Elastic Asset Allocation in its simplest golden form. Score assets by momentum and low correlation, hold the best ones, and automatically move towards safety when the opportunity set deteriorates, exactly as laid out by Keller and Butler.